Hi, this is Randy Finney with the Right Side of the Chart, and today's Tuesday, February 14th, 2017. Happy Valentine's to everybody out there. Wanted to go over an overview of the markets, what I've been doing the last few days, just some of the things that I'm watching, not an all-inclusive video, but again, some of the more important things that stand out at this time, including a couple trading ops. I won't get too much into detail on that. I want to do an overview starting with the broad markets. We'll take a look at what's going on there, roll into gold and GDX. I had inadvertently skipped the miners and the precious metals on the last video, and then just wrap up with a couple other things that I'm looking at. All right, this is a SPY. We'll just stick with the 60-minute charts here on the indexes because that's all I'm really focused on right at this point in time. Longer term charts, again, all that analysis is there. If you're new to the site or haven't really caught up lately, just click under the market analysis tab on the front of the page and you can go back and see some of the daily and weekly charts. So this is the 60-minute charts, and as I've said, we continue to wedge or inch our way higher slowly but surely with a series of divergent highs, and most importantly, as I mentioned, each of the divergent highs that we've had has resulted in a correction, small pullbacks, not a correction of 10% or more in the typical sense, but corrections at least on this time frame. In the bigger picture, if you look at what I did is I added this yellow trend line. You can see the series of divergent highs, and a lot of those are marked here. But up top here, I'll make it a little bit brighter so you can see that. This is the big picture. So from this point way back here in looks like early November. From that point, we've been making a series of higher high on prices and a series of equal, or in this I should say lower highs on the PPO and the MACD. RSI really from that point, this is where we really started the divergence on the RSI back in early December. Either way, point being, this is multi-month divergences on just about every price and momentum indicator and oscillator that you have that you want to put up. You'll see these divergences, and as such, that warns of a likely trend change when you have such long-standing and very clear divergences across the board. So has it been frustrating? If you've been short, yes. Now, should you have been short? No, we really haven't had any sell signals. I've mentioned, I have very little desire other than a very small starter position on the small caps. I don't have any shorts on the broad markets, although that may change after today. I may start scaling into some broad market shorts. But this is the SPY. Here's what I'm watching on the 60-minute. Most important is this very minor but pretty well-defined uptrend line. And it looks like we've cracked below that today. On top of that, we've had another important development or something worth noting, and that would be confirmed divergence. I often talk about potential versus confirmed negative divergence. When you have the indicators moving higher, whether it's the RSI, the PPO, the MACD, they always have the chance that they may take out the previous highs and thereby negate or undo that negative divergence. So in my book, divergence is only confirmed once you have that bearish crossover, which has then effectively put a lower high in place on the indicators, and that's what we have here. You can see the PPO making a bearish crossover today. The RSI has moved down off the highs, especially from overbought levels. Like to see that as well, and we've had this trend line break. So this is a we'll call it a minor sell signal. There's not any impulsive selling yet, and because this trend has been very resilient, you may want to just give this one a little time. There's a gap below. Watch for a backfill of this gap. Let's see how prices act off that level, about 231.82 at the bottom of that gap there. And if that gets taken out, I think it's safe to say that a new downtrend, at least a pullback, will be underway. And at very, very minimum, I expect a pullback to wrong drawing tool there. A pullback to that uppermost horizontal line right here, and more than likely down to this yellow uptrend line. Now, if that breaks, if and when, I expect a little reaction when we get there, but if and when that breaks, which I think it will based on everything, not just on the 60-minute time frame, but things going out on the longer term time frames. In fact, before I get to the Qs and IWM, I want to digress for a second. I want to just let you know my thoughts on the market right now. everything that I'm watching and the way I feel, I've been trading for many years, you get to that point, if you see divergences and bearish technicals, a crazy run that's not really backed by fundamentals. In the past, I've gotten to that point where I think you feel like giving up, like technical analysis doesn't work, the markets are going to go up forever. Now, I know a lot of you have reached that point weeks ago now. As a rookie trader, I would reach that point earlier. At this point, I've sort of been sitting back patiently, waiting, although I've been expecting a deeper pullback. The evidence just hasn't been there in the charts. But I want to let you know the low volume, extremely low short interest. I could ramble off a half dozen or more reasons why I think we could be on the verge of a very sharp and fast correction. These are the things I'm looking for, these breaks of these trend line supports, and some other things there. And on that line, I wanted to add, don't underestimate the scope of a move. Everyone has to define their time frame. If you are a quick trader or you're new to trading, you want to get a few wins under your belt. It's been certainly been tough since the presidential elections, at least in my opinion. The markets have been very difficult because of all the noise after the elections. But my point being, you can go for a few percentage points if you're looking to short, or you can trail your stops down to protect profits, maybe set stops at break even. Let's say you shorted here on this trend line break and you want to put a stop not too far above the highs, or wait for a little bit confirmation on the downside. But be open to the fact that there can be a lot more downside here. And in trading, if you're taking small gains and you're taking small losses on your stops, well, you're going to have to be right a lot more than you're wrong. And that's very hard, almost impossible to do in the market. The key to investing is, risk reward. Risk $1 to make $3 or more. So your stop should be small. You're going to be stopped out. You're going to be early or wrong on trades, whether they're long or short, but don't underestimate the value of letting your profits run. Sometimes I'll take partial profits. Sometimes I'll game a reversal, I should say off that trend line, cover shorts, trade alongside bounce or get out and then jump back in when that trend line's broken. Just an example. I'm not saying I'm doing that in this situation, but I just wanted to let you know that there is a potential for a significant move, and I do think one is coming within the next month or so. I've thought that for a little while. It hasn't come, and that does not mean in any way it's not going to come. In fact, on the contrary, all the technical evidence that I'm looking at points to the fact that we may be looking at just one of those very sharp swoons down like we had in over the last few years. We've had several of those. All right, let's move on. Enough of that, but I just did want to impress upon the point that I'm not looking for a 1% pullback in the Qs. That would be my minimum target right here, down to about 125.85. We're still in a 60-minute time frame. So you can see this is another reason we don't have a sell signal yet. I mentioned in recent videos I'm watching this minor uptrend line here. This was a previous uptrend line. It was really a rising wedge, which was broken and back tested. Now I could pull this line out here and really draw it like this if I wanted to. I'm just going to leave it the way I had it, because prices seem to be acting well off of it. But this now is the line to watch. So we do have, as I just pointed out, a breakdown in that comparable near-term uptrend line on the SPY, and I'm looking for a breakdown in the Qs. I'm also looking for that gap right there. You can see the gap from the other day. I want to see that taken out. So really, let's just say the Qs under 127.51. That would be quite likely open the door to a breakdown and a move down to any or all of these targets. These lighter lines are just very minor support levels, any of which could produce a reaction. I see more significant support here around 123.88. And then, as I mentioned in recent videos, my preferred scenario at minimum is a move down to this intersecting T1, T2 level. T1 is that horizontal support at 121.62. T2 is this purplish uptrend line. We go back here, you can see quite a few reactions back here, and that line hasn't been visited yet. So again, if you want my best guess on where prices are heading within the next few weeks, there's a lot I really wanted to talk about in this video. I'll also mention that this Friday is OPEX, meaning standard options expiration. I've talked many times in the past of the tendency for the stock market, for the powers that be, to hold prices up into options expiration, only to see the markets correct within a few days, sometimes immediately after options expiration. So at best, I think the market might hold up until the end of this week, and sometimes you start seeing that, you start to see that OPEX fade, I call it, the ramp into OPEX and then the subsequent fade after options have expired. You may start to see that kick in a little beforehand, because this market seems very heavy right now. So there's the Qs, that's a minimum pullback, and if and when we get there, we'll just take a look at the other time frames, the other charts, some individual stocks. I'm talking about the market leading stocks, and then I'll try to determine to the best of my abilities whether we're going to have a substantial bounce there, or maybe something fleeting, or possibly smash right on through there. And there are times that significant resistance levels, or support levels, I should say, get taken out, especially during a downdraft, a sharp downdraft, which we could be looking at here soon. But again, wait patiently. We don't have the evidence yet. That would be one of those, that trend line break there. Here's IWM, same story. I know I sound like a broken record, but it is what it is. We've been trading sideways now since early December, and yesterday we hit the top of that resistance zone, and so far it has contained prices. You know, we had a brief spike above, but we failed to close, really make a meaningful close above there on a 60-minute chart. We pulled back down, so right now IWM is at the top of a well-defined trading range. So as such, if you're an aggressive trader, you want to put a short on here with a stop, let's say a couple percentage points above. I think that's objective. It's not the most objective entry because we don't have any sell signals yet, but you can either short as a trader, whether you're going long or short. You can short a breakdown of support or a bearish chart pattern. Likewise, you go long on a breakout of a bullish chart pattern or a break above resistance. Or you short at resistance. So this is a bounce into resistance. We have negative divergences, and now those are confirmed also down here on the 60-minute chart on IWM. We didn't have that before, and now we do. So I'm looking at IWM at resistance with divergence in place, and the charts, especially more importantly on the large caps, seem to indicate some downside. So in my opinion, it's an objective time to go short here with a stop not too far above, because your loss, if stopped out, is minimal, and the downside potential, especially if we go back down to the bottom of the range and then break down below, and we can go on to hit any or all of these targets, possibly more. And again, that's a favorable risk to return ratio in my opinion. All right, let's talk about the precious metals, since I didn't touch on those on the last video. Not much has happened since my last update. In the last week or two, I've pointed out the negative divergence. I'm sticking with a 60-minute time frame here. That's what we were looking at on the broad market charts. So the story is the same. We have this bearish rising wedge. We had gold at resistance at 1732 level, popped briefly above it. I had covered all that recently, and then we fell back below that level. So we failed that's a failed breakout of resistance. We had a bearish rising wedge pattern, which we've since broken down below. We had negative divergences down below on the PPO, the trend indicators, the RSI, just as we had bullish divergences back here at the low. And these are what I look for tops or bottoms for trend reversals. And so far, if I look at the scope of these divergences, how long they took to build, they lasted, probably about, looks like 5 or so weeks. This little move that we've had down so far doesn't appear to satisfy the scope of these patterns and these divergences. So my expectation is for more downside. I'm still short the miners, and I am looking for and do plan to get long the miners again when the time is right. And if gold really has some legs here, it is possible that it's working off these divergences more in time. See how we're really not moving down impulsively. We've sort of stalled out here. In fact, really stalled out here. We made a marginal new high. And gold may want to go ahead and burn through these divergences and move up. And if that's the case, then I'm profitable on the GDX short position by a fair amount, and will be, so I'll set my stops more than likely at least at break even at this point. Let me get into those charts for you and show you what GDX looks like. GDX, as I've mentioned, we had a divergent low back here. I pointed that out in the beginning of the year, and fast forward to today, or most recently, I should say, we had a divergent high right at resistance. I had this resistance zone here. We hit that bottom of that zone almost to the penny, and you can see the negative divergence in place, just as we had bullish divergences here. And this is the trend line that I'm watching right here, this lower uptrend line. So watch for a break of that trend line, and any or all of these horizontal lines are potential price targets. And as I mentioned recently, I believe, I'm not sure we'll get there, but I would certainly be covering any short positions if we approach this support zone down here, which it runs around ballpark. It looks like 2050 to 2180 or so. That's where, especially if the charts confirm when we get there, I'll more than likely be covering any short positions on the miners, and possibly even reversing back to a long trade. But as of now, we don't have any screaming sell signals. We do have the divergence and a failure at resistance, but we need to see what happens with this trend line, and then how GDX acts on each and all of these levels. And as I often say, in my opinion, analysis on gold is not complete without looking at the US dollar. I've been pointing out this bullish falling wedge on the 60-minute time frame all the way back to when prices were still within it. We broke out, back tested, move up, and we hit my first target, and just today we stalled at my second target. You can see how well that resistance level has acted. We had a big green candle running up, and so far that stopped this advance cold. So that is resistance until taken out, and if it's taken out, then I do see some minor resistance here. I should add another potential stopping point, without a doubt there, around 26, 28 on UUP, and then above that 26.36, and at this point in time that would be my uppermost target, but it's really hard to say where we might reverse. You can also put an uptrend line here. This is something to watch to keep this near-term, very near-term bullish uptrend healthy. Would be for UUP, the dollar ETF or ETN, to stay above this uptrend line. So there's your support levels. You have horizontal support here around 26, which was the first target, and you have this uptrend line. So any pullbacks ideally should be contained around that $26 area. Okay, as far as trade ideas go, I've had quite a few updates within the trading room. I can't recall if any of these have made it to the front page, but one of the biotechs has stood out to me for a while, and I think this may have begun with an inquiry from some members in the trading room, is Gilead, GILD. This one I like as a bottoming play. The case has been made within the trading room, and again, I may have posted some things on the front page, but it's very interesting. Gilead was also a short candidate. In fact, for those of you who've been with the site, you may recall back in July 30th, 2015. I put together a comprehensive video, clearly making the case for not just a pullback, but a correction in the biotech sector. That video was published exactly 10 days after the biotech sector bull market ended and before the biotech sector dropped. XBI fell by over 50% from that point, over 51%, I believe. So very timely video, and in that I covered Gilead. Now what's funny is I just noticed this trend line here, the support line. You can see when you look on the pop-up box, I created that line back in 2014, well before the biotechs even fell. And if you take a look, let me see if I can find this for you here. This is a screenshot from that video back on July 30th. And on that chart, I covered a daily and the weekly time frame, and I mentioned that this would be an objective short entry here, a break of this uptrend line, and that I expected that to happen soon. And you can see this was the only price target listed on that daily time frame. And here we've come full circle. We're in 2017 now, and you call it coincidence or not, but this is technical analysis. We've reversed from less than 1% of that level. We came just above it. It's like 65 and change. You can see if I put the crosshairs here, 65.43, low 65.38. So we effectively hit that target again from what, a year and a half ago. It just shows you how technical analysis works. And this is what I talk about when I'm looking for a correction. Now at Gilead, I didn't say back then this was my final and ultimate target. In fact, I had an earlier target that I mentioned. But what I refer to is, when I can identify a trend change, whether it's bullish or bearish, and then I mentioned, my targets are sometimes they're moving targets. As I say, I may decide when to close that position or even reverse from long to short, depending on how the charts look at the time. So we fast forward now to February of 2017, and this is the pattern I've been posting within the trading room: a bullish falling wedge pattern defined by these two white lines. We have positive divergences, which just like at the highs, I was pointing out the negative divergences. So bullish divergences on the RSI and the PPO. And this would be the first price target. Now, this may be a dead cat bounce within a bigger bear market for Gilead, but I don't think so. I think the fundamental story's been made. I don't know how secure this dividend is, 3.13, but you're getting paid to stay in this one. So regardless of my outlook for the biotech sector, which is mixed, if there's time I'll get to that in this video, this particular stock looks good. It's already had a heck of a correction. It's fallen to long-term support. You can see resistance here really coming in around, you have both the downtrend line and that 70.82 level, which is roughly the top of this gap. Yeah, there's a reaction a little bit lower, but I see some more reactions up here. So I think this one's good for a bounce up to at least that 70.82 level, and that's a pretty decent move. And then any or all of these other horizontal lines and or downtrend lines can be potential longer term targets. Let's look at a weekly chart. This is a weekly chart of Gilead. This is back at this point in time. I had pointed out the breakdown and back test and the divergent high. Again, these were targets created way back then in 2015. In fact, if we take a look at, I believe, here's a screenshot off that video. When the stock was trading at 117.34, and this was my minimum weekly target. Down here, T1 in the low 80s. And since then, I added another one. Well, that's at 64.75. That's a long-term support level. You can see the reactions back here. And you can also see that same bullish falling wedge on the weekly chart here. Divergences in place, bullish divergences, just like we had negative divergences at the high. So, my trading style I consider somewhat simple yet effective. You have to wait patiently sometimes for everything to come together, but my favorite trades are on the short side, overbought at resistance with divergence in place, just like I like to see oversold at support with bullish divergences in place for longs. And if I'm wrong on Gilead and this is just a dead cat bounce within a deeper bear market, then my stops will be not too far below that level. Probably on a weekly close, so the downside risk is minimal and the upside potential is pretty decent. All right, since I mentioned the biotechs, I'll touch on those real quickly. Like I said, this is where within 10 days I called for a bear market in the biotechs, emphatically making the case very unambiguous that they were headed lower, and they did, and didn't know exactly where they'd stop until they did. But actually, I believe we covered, we had a short on LABU, the 3-time bullish, and covered that somewhere. Very profitable trade, and that was an official trade on the site. And since then, traded long, short. And like I said, this may be, it's too early to say, if this is simply a bear market rally within a new, larger secular bear market, or if this bear market that we had in the biotech stocks that took XBI down over 50%, if that was enough to really satisfy, work off the overbought and overvalued conditions in the sector. But either way, there's our primary uptrend line. We're still well below that. The case I made in recent weeks, we've only retraced. We've had 3 failures so far at the 50% Fibonacci retracement. I'm talking about the entire, no, not the entire bull market, of the correction, I'm sorry. So when you measure the move from the top, this was the end of the bull market back in 2015, down to the lows. You can see these are the Fibonacci retracement lines. And so we've had 1, 2, 3 failures at the 50% fib. We haven't really failed there yet on this third attempt. We're trading right just a hair below it. But I mention that because, typical counter trend bounces usually stall out anywhere between the 38.2 all the way up to the 61.8 fib. So until and unless, technically, until we take out that previous high, you can't claim this is a new secular bull market. All it appears at this point is this may be like I said, a counter trend rally in a new, larger bear market with more downside to come. But I don't want to spend too much time on it. My thoughts are mixed. In my recent coverage on the biotechs using XBI, this large symmetrical triangle pattern, the yellow lines, was the most significant development. Of course, there's horizontal support resistance lines within there and bullish and bearish falling wedges. You can see how well prices act on the breakouts. XBI trades very well off the technicals. And normally, and I have to chalk it up until I see otherwise, that we had a breakout above the symmetrical triangle. So on face value, that's bullish. However, I have the volume bars muted down here. I'm trying to save some time to get this video wrapped up, so I don't want to go and turn them on. I can just tell you this breakout has been on below average or not on above average volume. I like to see impulsive price action and volume expansion at least 1.5 times or better the daily average volume. And so far, this breakout, the volume has been somewhat lackluster. So I'm a little suspect of it. I'm just, for the most part, I'm not engaged in the biotech sectors other than Gilead, a couple others, CARA. I probably should have pointed this one out yesterday in the trading room. I was watching CARA, and it did pull back to my first target, 1335, after a big run up. It stalled out a little shy. It was getting very overextended. I had made several warnings in the trading room, time to tighten up stops. I had personally taken profits there and was waiting for a pullback, which I got yesterday, so to add a little bit back, and a nice bounce. So you can see again how well technical analysis works. This was a target before, and which was also a reason it was a target. It was a well-defined resistance level with numerous reactions. We happened to blast right on through it, however, on the pullback, and it was a pretty sharp pullback. It only lasted a couple days, but we tagged that level almost to the penny. The low was 1332, and that level was at 1335. Close enough for government work, especially considering that was a lot of downside momentum or velocity heading down to that target. So it's not surprising it overshot it by 3 cents. And then today it bounced. I think at one point it was up almost 15%. So again, this is a good long-term tuck it away, and nice fundamental story behind this one, as well as nice technicals. Tons of volume coming into the stock recently. And at this point, I probably should point this out. You can draw an uptrend line here. This is what you want to watch. Let's see let's hope that the stock stays above both this uptrend line as well as that 1335 level. Otherwise, that would certainly be bearish if it broke that. There will be a little support here at this reaction high, but if that gives way, the next stop really is all the way down to $11. That would be your next support level. It'd be a pretty ugly fall from where we're at. So probably not a bad idea if you're long this one to have a stop. Either on a daily close or maybe a 60-minute close, somewhere a little around that $13 area. Okay, I'm wrapping this video up with just one other trade idea. This one I've been harping on for quite a while, and I do feel that we're still looking at a very substantial correction, and I'll not be careful with my words. I'm looking at a bear market in the semiconductor stocks this year in 2017, and more than likely to kick in any day now. We're right on this. Here's a bearish rising wedge pattern. I've gone over the semis a lot lately. XSD is another semi ETF. SOXX is another one, and they're all telling me the same story. Very steep negative divergences, very clear, a very clean bearish rising wedge pattern, a series of divergent highs. Yes, we've taken some shots. We had some profitable trades. We've had more stopped out than we've had profitable, and that's because the overall trend has been up. But I wanted to point this out that, in the semis, I'm not looking for a 3 to 5% pullback. When this sucker breaks, back tests are always possible. I don't think we're going to get one, although it is possible. But ultimately, I think the move down in the semis, from where we're trading today, Easily see a drop down here. That would be about a 12% drop, and ultimately, I think before all said and done, we go down here, and that's over 20%, about 21%. So this is still one of my most, in my opinion, one of the most promising sectors on the short side at this point in time. Although, just like the broad markets, we don't have that sell signal yet. We're very close. What would look really nice on this chart would be either a big bearish engulfing candlestick or a big red candle down smashing right through those trend lines. There's a lot of different ways this can play out, but that's one that's on my radar. So just be ready. Have your ducks lined up in a row. I've covered a lot of these individual semis, and I have quite a few on my watch list. So if the semiconductors break out, I may start pumping out trade ideas, official trade ideas. They may be coming out quick. I'll try to get the charts out as quick as possible, but you can always short the ETF, and you can use the leverage ETFs if you like. SOXS and SOXL, excuse me. Those are the 3-time leverage. And just be careful with those 3-time leverage ETFs. They tend to have decay over time. The only time that leverage works in your favor if you're long the ETF. So in this case, if you bought SOXS, which is the 3-time short, if you saw a waterfall sell-off with very few givebacks, meaning days where we had a sharp green close, even though the trend was lower, and then ultimately moved down, this is what works against you with the leverage ETFs. However, if you get a waterfall sell-off, a straight move down with very little give back, you can actually do better than 300% the drop in the sector, or in other words, better than 3 times the drop in the sector. And if that doesn't make sense to you, check out the frequently asked questions I talk about. It's under the ETF section. I give a written example of how that decay works against you in a choppy market or a choppy asset or sector, but it can actually work in your favor if there's a waterfall sell-off or a very powerful rally. Same thing with Nugget earlier in 2016, and especially back in 2017 as well as early 2016. If I'm not mistaken, there was a period that Nugget substantially did better than 3 times the return on GDX. All right, let me wrap it up there. Long video. Didn't plan for it to be so long, but I touched on everything I wanted to. So if you guys have any questions, drop me a line in the trading room, and I'll get back to you as soon as possible. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.